Now, the FDIC is getting ready to break apart failing banks into their good and bad parts to try and drum up buyers. But will anyone show up to make a bid? Billionaire investor Wilbur Ross is the chairman and CEO of W.L. Ross & Company. He has said that the proposed guidelines to buy the banks are onerous and that these rules will only keep buyers away. Wilbur Ross joins us now. Thanks so much for being here.
Good to be here today.
So what are your strongest objections to the FDIC's bank buyout proposal?
Well, the rules on private equity would require 15% equity capital maintained for a 3-year period. There isn't a bank in the United States that has 15% equity, and there's a good reason for it. It's not economical. You can't make a rate of return on the unused excess capital. And what's strange about it is a startup bank is only required to have 8% capital, and a regular bank that's been up and running for a while is generally viewed as well capitalized with only 5%.
So you think it's an uneven playing field?
It's a totally uneven playing field, and it's unnecessary. It can't possibly be that a bank that's rid of its toxic assets, marked everything to market, and supported by a loss-sharing agreement with FDIC cannot possibly be more dangerous than a startup bank. That's silly.
So what would it take for you to buy another bank?
7.5% or 8% capital, I think, would be an appropriate requirement. That's what they've let people use historically, and I don't see what's changed in the few weeks since we bought Bank United to require such a massive change. Particularly, many private equity firms, ours included, have a demonstrated track record of buying failed banks from other countries, fixing them, and making them be good banks all over again. So it isn't as though there have been a lot of bank failures caused by private equity people. To the contrary.
You were talking about your purchase of Bank United. Are you worried these guidelines will affect your purchase retroactively?
Well, we're assuming that they wouldn't be so unfair as to impose them retroactively, but that is one of the points that I made in my memo. We did negotiate with them a capital requirement. We did negotiate with them a holding period. We negotiated the various elements of these proposed rules, and it seems bizarre that those formulas were agreeable shortly before Memorial Day, and roughly 1 month later, they proposed to change the whole thing. So I'm optimistic that they'll get enough comments and these will be brought back to something reasonable.
Now, just to play devil's advocate, it's not the Wilbur Rosses that everyone is worried about doing dumb things in the banking industry. Aren't you worried, or isn't it a legitimate concern that lack of regulation could attract B and C players that don't have a sterling reputation like yourself that could do even more damage to banking? Well,
okay, that's true, but there are B and C players in the big commercial banks as well. Hundreds of them have had to get TARP money, so it seems to me that's quite a report card on those people. But if they don't feel that a buyer is a good buyer, the right thing is don't let them buy the bank. If they don't feel the parties trying to buy a failed bank are qualified, don't sell it to them. Don't let them in the bidding. So there's a much easier solution than imposing a requirement that nobody will be able to bid on.
Let's switch gears now to CIT. It's in the news. It did not select, reports say it did not select a near-term liquidity proposal with the most attractive economic terms. Are there parts of CIT that interest you since your firm is involved in the railcar business?
Well, there are quite a lot of parts. CIT is fundamentally a very good series of businesses. Their problem is they were very capital market reliant, and when the capital markets failed, their funding sources dried up, and therefore they have a liquidity problem. But their factoring business is a good business. Their small business lending business is a good business. Their vendor financing is a good business. Their railcar leasing is a good business. Their aircraft leasing is a good business. CIT's problem was not so much its present asset mix as its liability mix, too much short-term debt.
We want to hear your take on the markets. Do you think the recent run-up reflects better economic health?
Well, I think that the enthusiasm is a little bit exaggerated. I think everybody was so desperate for good news that they're interpreting things as good news. In the normal course, 585,000 jobs being lost in a month would be viewed with horror, not with claim. Similarly, the fact that housing prices went up in June from May is nice, but the real fact is they declined sharply from June a year ago. And it's really the year-over-year comparison that I think needs to be brought to break even before we get out of the housing mess. So I feel a little less bad than before, but I don't think that this crisis is over with by a long shot.
When are you thinking?
I hope sometime out in 2010. A lot of the government programs, particularly the infrastructure programs, take a while to take effect on the economy. And similarly, I'm optimistic that the public-private partnerships that Treasury announced and a similar series of them that Sheila Bair has announced for FDIC to buy toxic property paper from them, I have a feeling that those will tend to stabilize the market when coupled with the mortgage modifications and refinancings that are going on. But all those things take time. Nothing happens in 5 minutes. This is a very big, very complex economy. So I think by this time in 2010, we'll see some true green shoots.
We appreciate your indications and explanations and everything and wish you the best. Thanks for joining us. With that, Wilbur Ross.